private equity, and it certainly has its supporters and detractors. It certainly carries with it a lot of emotion. It's not new, but in the current form it's new. It's something that's seen very positively in many parts of the world. We want to explore today how this private equity is going to shape this part of the world. We also want to see how private equity can give something to this region and what sort of returns are private equity players looking for. And in a broader context, we want to see what the prospects for global private equity are in the medium to long term. And that's a great way to start or segue into David Rubenstein's presentation, who's going to give some context to that question. Thanks, Dave.
Thank you very much. My job is to tell you everything you need to know about private equity and private equity in the Middle East in 15 minutes. So I'm going to talk very quickly. I hope the interpreters can keep up with me. Before I do that, how many people here are actually in the private equity business? Anybody? Okay. How many people want to be in the private equity business? Okay. I want to be in it too. How many people want their children to be in it? That's the most important question. Everybody, hopefully. Let me give you a little overview of private equity today as we see it. And the reason we're having this session today is because private equity has become very prominent in the world. 5 years ago, when the World Economic Forum started its Middle East Forum, they didn't have a session on private equity anywhere, nor did they have a session on private equity in the Middle East. So we've come a long way just in 5 years to the point where the World Economic Forum feels it should address this subject. Private equity, and when I say private equity, that is a phrase really for, I'm using it for buyouts or buying control of companies typically, or things like that. That was an industry that was really started in the United States probably in the mid to late 1970s. And at that time, the transactions were called bootstrap transactions. They were very novel because it was an unusual concept to buy a company using somebody else's money, in effect. Over thousands of years of history, when people wanted to buy something, they had the money all to themselves. They would buy it. They wouldn't use debt. They would just use their own money. But in the mid-1970s or late 1970s, the concept grew in the United States that you could buy a company using the cash flow of the company you were buying to service the debt that you were going to borrow to make the acquisition. It was considered very novel at the time. Today doesn't seem novel, but the idea that you would put up 10% of the purchase price, which that's all the money you might have had, and you'd borrow 90% or 80% of the money to buy something, that was a novel concept. These deals, then called bootstrap deals, later became management buyout deals or leveraged buyout transactions. And they grew in the United States in the late 1970s, the early 1980s, and the mid-1980s to the point where a lot of investors said, hey, these deals are making a lot of money. I'd like to invest in it, in this area. And as a result, public pension funds in the United States increasingly said, I'm going to put my money into these buyouts, and I'm going to back firms that are doing buyouts because virtually nothing you could do with your money that was legal would get you a better rate of return, because the buyouts were getting returns in the 25, 30, 35, 40% annualized rate of return area. And so what grew up in the United States was a whole industry of people doing these kinds of buyouts. Now, whenever you have something good in life and you think it's very attractive, what you want to do is share it with somebody else or brag about it or take it elsewhere. And so increasingly the private equity people said, well, we have invented a very good concept here, and let's take it overseas. And what was the concept? The concept was that you would buy something with somebody else's money, in effect, or the cash flow from the company you were buying. You would borrow the money. You would get yourself involved deeply in the company that you were buying. You wouldn't just be very passive. You'd serve on the board. You'd have the ability to change the CEO. And you would do two things that were really novel as well. One, you would sell the company in 3 or 4 or 5 years and give a return to your investors. You wouldn't hold onto it forever. And then you would go about and do another transaction. And so the idea of just serial transactions, getting good rates of return, and really not worrying about things other than high profitability, that was the concept that was that the American groups really took on and were confident about. So as this industry grew, they began to do something that I mentioned. They took it overseas. They were bragging about it. They were confident that they could take this technology and export it. So it was exported in the 1980s to Europe and in the 1990s to Asia. And increasingly, as this concept was exported, it began to be the case that in Europe and Asia, people made money doing these kinds of things as well. Companies would be bought using debt. The companies would be analyzed very carefully before they were bought. And then once they were bought, new techniques would be used to make the companies more efficient. New managers would often be put in. The private equity people would spend a lot of time trying to make sure the companies did perform well. And typically in 3, 4, or 5 years, the companies would be sold. Annualized rates of return of 30 or 40% would be achieved. The investors were very happy. The private equity people were very happy. And life seemed to be very, very pleasant. Right now, in the last 2 or 3 years, we are at the apogee, really, of the private equity world. Today, private equity is the face of American capitalism, and to some extent it's becoming the face of European and Asian capitalism, in the sense that we see more and more deals getting done by private equity people. 30 years ago, 20 years ago, 10 years ago, the face of American capitalism would have been Ford or General Motors or Chrysler or U.S. Steel or IBM, but now it's large private equity firms like TPG or Carlyle or Blackstone or KKR, because they are moving the economy. They are the ones that are making things much more efficient and much more productive, in my view. Now that the industry has become institutionalized, the large firms doing this in the United States are quite large and globalized. In other words, this technique has been exported to Europe and exported to Asia. The question has been raised, is this a good thing? Well, it's been a good thing for investors. Investors have made more money than anything they ever thought they could do in the investment world. And over a consistent period of time, 5 years, 10 years, 15 years, buyouts have proven to be a very, very good way to make money for investors. And for the general partners, obviously the general partners have done quite well. Their organizations have grown. They have flourished. They are now the place that people want to go work. They've become the largest source of fees for Wall Street. But the question has arisen over the last couple of years, and really in the last 2 years and probably in the last 6 months more than any other time. Is this a good thing for the economy generally? Is this a good thing for workers? Is this a good thing for business community generally? And the reasons that these issues have been raised is this. One, the focus of the private equity people is on one thing, frankly, making money, high rates of return, doing transactions, going on to the next transaction. Some people have said, well, that's a nice thing for the investors, but what about the workers? The workers don't often fare quite as well. What about the local community that might have a plant in its facility, in its area, and now might have been moved? What about the local tax base? Is that tax base going to be impaired? And so questions have been raised in the United States, in the Congress, by labor unions, by the press, and by the business community generally about whether private equity is, on the whole, a good thing. Now, the private equity industry, for the first time, has to justify itself. For the first time, the private equity people have to say, well, we actually are doing something productive. We're making companies more efficient. We're paying a lot of taxes. We're not destroying jobs. We're creating jobs. But this is novel for the private equity world because they haven't really been challenged before. And now, for the first time, the private equity world is getting together and saying, well, here's how many jobs we've created. Here's how many taxes we paid. Here's what we've done for economies. Overseas, the same issues have been raised, but in a different context. Of course, overseas, people wonder as well whether workers are being laid off, whether taxes are being paid, whether this is a good thing for their local economies. But because so much of the private equity industry has been American firms investing overseas, the issue is, are we letting foreign capital buy critical assets in our country? So many countries in Europe and in Asia have begun to say, well, not only are we not sure whether private equity is good, but we're not particularly sure whether we really want foreigners doing private equity in our country, or at least doing it to the extent that they're doing it. So private equity, not only because it's become so large and so institutionalized and so profitable, has been challenged in the United States, but it's also being challenged overseas, particularly where a lot of private equity money has gone. So today, as we talk about private equity, we talk about it in the context of the Middle East. Historically, you could say there were three centers of private equity. There's the United States, there's been Europe, and then there's been Asia. The Middle East has been relatively not as affected by private equity as those other three areas, but that's changing, and it's changing for a number of reasons. First, when great wealth came to the Middle East in other times, much of this wealth was recycled outside of the region. Now, increasingly, more of this wealth is staying in the region. Secondly, private equity firms are much larger than they used to be, and they are now looking for other areas to pursue opportunities. Third, private equity professionals often trained in the West are now coming to the Middle East, trying to employ the same techniques that were used in the West or in Asia or Europe, and as a result, you have a large cadre of private equity professionals. Fourth, governments are now more willing to privatize things in the Middle East than before, and as a result, a large sector of the economy is now open to private equity investment. Fifth, family organizations, which historically held on the companies through generations, are now saying, well, maybe private equity can give me fresh capital to help with a generational change. So as private equity becomes much more common in the Middle East, and you see it much more frequently, the questions are, can the Middle East do private equity better than it's been done in the United States or in Europe or in Asia? In other words, can it be done in a way where it's clear that there's a concern about taxes, concern about workers, concern about local communities, and not just a concern about high rates of return and investors getting a very good use of their money. In addition, the question has been raised of who is the best person to do private equity in the Middle East. Is it local, indigenous private equity firms that truly have no connections to the West but use some of the techniques that were developed in the West? Or is it better if the private equity operations in the Middle East are done by global private equity firms which have perfected these techniques before and can use some of the techniques and the skills and the contacts that they have developed elsewhere in the Middle East? It's also a fair question to ask whether private equity in the Middle East can be as important as it has been in other parts of the global economy. In the United States, it's become, as I said, the face of American capitalism has really become private equity. In the Middle East, it's not likely that in the short term, in my view, private equity will be as dominant as it has become in the United States or even Europe, but it's beginning to make inroads. So the questions I think the panel should address are, one, is private equity, generally speaking, and the globalization of private equity been a good thing for the economies that have been affected by it? And if it has been a good thing, can it be a good thing for the Middle East? Secondly, who is best to perform private equity in the Middle East? Is it the local private equity firms only, or global private equity firms are going to play a role as well? And can the Middle East modify and improve upon the model of private equity that has been used elsewhere to make it more consistent with the culture and the business nature of things in the Middle East? These are questions that are not yet fully addressed by anybody because Middle East private equity is relatively in its embryonic stages. But clearly, 5 years from today, I think private equity will be a much more important force in the Middle East, and I think that you will see the techniques that have been perfected in other parts of the world, at least used in other parts of the world, modified to take into account the culture and the specific business nature of things in the Middle East. So with those comments, let me leave it open to the panel to address some of those things. Okay? Thank you.
Thank you very much, David. Perhaps you could just elaborate for us on the issue of how you see the Middle East now with private equity, just perhaps.
Okay. Historically, the Middle East was not that receptive to private equity, honestly, and that was in part because there were very few opportunities. Governments owned a large part of the economy, and families that owned things didn't really tend to want to sell them. Private equity only works if you have a seller who wants to sell something, because private equity people have to buy something. And in addition, you often felt that in previous times that private equity wasn't probably as welcome. Private equity was viewed as a Western type invention and therefore wasn't seen as operating on principles that were as consistent with principles in the Middle East. In other words, the concern was only about in the West getting high profits, good rates of return, selling companies quickly, and moving on to the next thing. Whereas the culture in the Middle East is one of holding on to assets for much longer periods of time, not worrying only about profitability and worrying much more about other cultural things. That is changing a little bit, and in part because of the enormous wealth that has come into the region, the growth has attracted a lot of private equity players. But over the last 5 years, $1.4 trillion of wealth from the rest of the world has come into the MENA region. And that enormous amount of money is not leaving the region as much as it did when there were large oil price increases. Right now, a large part of that wealth is staying here. And as a result, the economies are growing, the GDP per capita is growing, the populations are growing, and I do think that it's a very fertile area to do private equity investing. My point, though, is that the private equity firms that do it need to be very sensitive to the concerns that have now arisen in the West. And the private equity firms that operate here have to avoid making the mistakes that the firms like mine did in the West, which is to say only focus on how profitable we are, how much money we're making for our investors, and not really worrying that much about whether we create jobs, whether we're creating productivity, whether we're being good local corporate citizens. I think much more of those kind of factors have to be taken into account in the Middle East if private equity is to succeed here.
Do you find there's enough deals here?
Well, in the United States, if something doesn't work, you sell it. I mean, if you're not happy with something, you sell it the next day, and you don't think twice about it. That isn't quite the case in Europe or quite the case in Asia. In Asia, for example, selling something has historically been considered a bit of a loss of face. And in the Middle East, the tradition of selling something if something isn't working perfectly is not really there. People will tend to hold on to assets much longer or fix their problems internally. But I do think over a period of time, you will find more transactions, in part because governments are privatizing things, in part because families are now recognizing that it might be a good thing to have outside capital in family companies. But I do think that while there aren't as many deals per capita as there are in the West, you do see more deals than you did 5 years ago or 10 years ago, and I think that trend will continue.
Good, thank you. We'll come back to that in a moment, and we'll come to the audience in due course, but I'd just like to explore a little bit more about what's happening here with the rest of the panel, and perhaps if we go to Henry Azzam from the Dubai International Financial Exchange to get his view about what you see is happening here and what you see are the benefits of private equity.
Thank you. We do have certain challenges that is facing the industry of private equity. We, as Mr. Rubenstein said, we're still in the early stages. Before 2005, we hardly had any private equity fund in the region. Now we have quite few of them, and the expected size by the end of this year could reach 20 billion with around 40 private equity funds operating in the MENA region. However, we still need to change the perception. We need to demystify the concept of private equity. It's still considered as being private equity investors as being people who are raiding companies, milking them, and exiting sooner out of that. We need to show that there is patient and intelligent capital provided by these institutions. This is one challenge. The second and more important challenge is to develop our capital markets. Without a viable, developed stock market, it's difficult for companies to exit, for private equity funds to exit out of their investments that they make 2 to 3 years before. And equally important, we need a developed bond and structured finance market. As Mr. Rubenstein said, 80 to 90% of the acquisition is done through borrowing. We hardly have a bond market, a viable bond market, and increasingly money for acquisition is not coming from banks, it's coming from institutions like funds under management, like hedge funds, like pension funds, like investment companies, like investment banks. These have not yet developed the sophistication needed. The third challenge is to develop the financial and legal infrastructure. I'm so happy to see Dubai International Financial Center, Qatar Financial Center developing, providing a home for these funds, providing a regulatory framework up to the international standards. All of us know that if you are regulated up to a certain level, it's easier for you to get rated. Once you get rated, it's easier for you to borrow money. So it's part of the development of the private equity funds. Our various stock markets are improving. It's easier now to list. However, the way companies are valued, companies going public are valued, the way IPOs are being executed still needs lots of improvement. Very few words on Dubai International Financial Exchange. This is the only international exchange between London and Singapore. It's an exchange that would make it possible for companies acquired by the private equity fund to exit. It's an exchange which is regulated up to the international standard and therefore provide an alternative for companies who would like to list in New York, London, but don't like the stringent constraints there, and there is an alternative for them. the whole issue of having the infrastructure in place, the whole issue of having the legal and the legislation. Do we have the required legislation in the region to undertake the private equity business? It is improving, but I don't think we have the courts, the judges, the legal infrastructure that is needed for this to be viable. And finally, another challenge that was mentioned by Mr. Rubenstein, but we can feel it more so here. Yes, you have the qualified people who have been doing private equity business internationally. However, when they come to the region, they need a few years to understand the culture, to understand the way things are done here. Always the shortage of human capital remains a challenge that needs to be addressed if this industry would take more activities in the future. Thank you
very much. I turn to Sharif Saraf now from Abraaj Capital. Do you agree with that, and do you have anything to add?
Well, I think definitely there have been there are challenges as far as the regulatory framework is concerned, but I think private equity in the Middle East over the last 10 years that we've sort of been practicing it has there's a lot of opportunity. You're looking at not only family businesses, consolidation opportunities, but you're looking at companies which today essentially in the Middle East are one country shops in many respects. The concept of going regional can be best provided by a private equity firm. As far as whether it's who's best to perform it, is it the local players, is it the global players? I think it's great to have Western talent. I think it's great to look at Western techniques, but I also look at something like, you've got Colonel Sanders in Kentucky Fried Chicken, which is global today, but you can't apply the Colonel Sanders model to a Colonel Rubenstein model today in private equity, which would actually say that global firms effectively would dominate in many of the local markets. I think the local practitioner best understands the local sensitivities, best understands the peculiarities, and it's a blend of the two that have to emerge. And I think the Middle East today, it's really at an inflection point. The first inflection point that was in the Middle East was during the First World War, when boundaries were defined, and it was not till the Second World War that the boundaries were finalized. But today we're looking at an inflection point where socio-economic change is going to take center stage, and I think it's private equity that's best equipped to be a catalyst for such socio-economic change. And just as you have a first mover advantage, I also believe in some respects you have a first mover disadvantage, because acquisition finance, for example, is not readily available and is getting to be. Banks are seeing that today it's not that acquisition finance is at the risk end, is a risky thing. They see it as less risky today than financing greenfield projects, which they'd been comfortable to finance in the past. So I think the industry is maturing. I think it's great that players are coming in. It augurs well for efficiencies in the corporate structure. It augurs well for governments today who want to become more facilitators of development and less to be direct investors. The self-belief today of the Middle Eastern corporate or the Middle Eastern or the Arab is a different self-belief. Today they believe that their region has the best promise. They believe that their people have the talent, and I think it's very interesting times to really in the next 5 years in terms of what the opportunities are, whether it be in terms of going into companies along leveraged buyouts because many of them are under-leveraged, or going into consolidation plays across the region because many are in industries which are extremely fragmented, whether you look at banking, insurance, telecom, across the region, the opportunities are immense. I think family groups, people talk about it as a great source of deal flow. I think that's still going to take a little more time, because while you have the regulatory challenges, I think the mindset challenges are a little more, and the concept of family groups still becoming a great source of deal flow for private equity firms is still going to take some time. There is definitely today a move within the groups to focus on core competencies. That augurs well, because there are many opportunities along those lines.
Good, thank you. I now turn to Saad to get his perspective on what's happening here. Do you have any difference of opinion so far?
Not really, but I can make some comments. I mean, I think we're seeing a lot of money being raised in the Middle East over the past few years, but I've read a statistic recently that approximately 5 to 8% of that money has been deployed in deals actually in the region. That's a very low percentage, especially when you look at 2007 and you see how many new funds are being raised this year. Having said that, I mean, I think that private equity is a positive force in the region. It will help if you look at the various constituents in the region, for example, like regional governments first, it will help the local economies diversify, for example, by getting new venture capital money in, by getting growth capital in some industries that are typically not as important. You also help increase employment by creating new jobs and investing money in new companies. And also you help create value, especially in like privatized state-owned enterprises. And this is a critical element to help regional governments. If we move to the family businesses, here I think, like David has said before, typically and historically, lots of family businesses have been reluctant to sell assets because it was perceived as a sort of shame to sell assets to a different family group. I think a private equity will provide a neutral party that could be acquiring the assets of a non-performing assets or distressed assets of a family business. Also, I mean, private equity can become a good partner for some family-owned businesses to help them grow, institutionalize, and get ready to go public. I can speak from my personal experience. I mean, in a previous life, I was involved in the acquisition of a company called Damas. It's one of the oldest jewelry retailer in the United Arab Emirates. We and a group of investors from Saudi Arabia partnered with the management of the team or of the company, took a 40% stake in the company, and we worked diligently to help institutionalize the business, to improve operating efficiencies, to help them grow geographically and expand our product line. It was a true partnership. I mean, we were a minority, but we had significant say in the decision-making process. And a year, for example, after the company was acquired, I mean, revenues went up 22%, profitability went up by something like 45%. I mean, this was a success story, and Damas will probably end up going public soon on a regional market. But again, as my previous colleagues have said, I mean, typically family businesses are not that open to private equity. I mean, they're increasingly becoming open. And also, I mean, with family businesses, they need to understand the value proposition. I mean, people lots of time make decisions based on how comfortable they are with you, if they were to partner with you. Valuation and prices is less important. I mean, for example, when we won the Damas transaction, it was mainly due to the fact that the founder had passed away, and me and some partners spent like 3-4 days at the house of the kids, and this was a very, very important thing. I mean, and they felt strongly about this, and they never negotiated valuation with us. So this is an important thing. You need to explain to them how you add a value to them, long-term and short-term, and value creation is critical here, more critical than it is in the West. In the West, we can do financial engineering and exit, but in the Middle East, it's very important to be able to create value in portfolio companies.
Good, thank you very much. Now we turn to Omar Alghanim, who's a very successful business person within the region, and has what probably many private equity firms would see as an absolute prize to being a conglomerate model to take on board and reshuffle and do all sorts of exciting things with. You've heard a lot of very positive things here with some of the challenges. What's your view?
It reminds me of a story. There's a guy out there, he's entering a pie-eating contest. He wins the contest, and the prize, some more pie. We've just won the capital raising contest. We've had over $1 trillion transferred since 2002. And now, more capital? I have a little bit of trouble understanding that. There's a huge overhang of capital in the region. There's and not much of that's being invested in the region. Of the top 10 MENA private equity funds, the investments, the top 10 transactions, only 2 of them have been in the MENA region. There have been more number of deals in the region, there have been, but only in 06, but only 30% of the capital was invested in the region. 70% was invested abroad. Let's take a look at the raised capital as a percentage of GDP. It's an interesting figure to look at. In the US, it's at 1.6%. In the EU, it's at 1.2%. In the Middle East, it's at 1.1%. That's in 06. Let's look at some of the forecasts for 2007. And that would bring us up to 2.4% of capital. A raised capital is a percentage of GDP. Boy, this is an industry in its nascent stage. I also have trouble seeing that. So what does PE do? It brings capital. Well, we don't need that. It brings sourcing, deal valuation, some technical, financial deal structuring skill sets. And Mr. Rubenstein's speech, he talked about how in the 70s and 80s there were some extraordinary returns done back then. And in large parts because those skill sets were fairly scarce back then. People were just figuring these things out. And these have now become commoditized skill sets. Understanding how to run a DCF with embedded option value, how to do all these things. I mean, this is not complicated stuff. And this is stuff that's taught at every business school now. Whereas back then it wasn't. And that really gave them the opportunity back then to be able to differentiate, look at this, create, understand that value and extract some of that value. So governance, control systems, incentive systems, that's certainly needed. And boy, there's a lot of value to be added there. But are private equity firms really the best people to be bringing that to this region? I mean, wouldn't we be better off bringing in McKinsey, BCG, who are experts in setting up governance models, who are experts in bringing in purebred, governance models? I mean, I don't necessarily buy the argument of bringing in private equity firms just to do that. Another thing is building first-rate management teams. I mean, as the point was made earlier, there's a lot of capital in the region. And as much capital as there is in the region, inversely, there's not enough talent. And the person who goes out there and develops talent and spends all his time developing talent and retaining that talent and getting the best talent is a person who's going to win. Because when that is the true scarce resource, that's the resource that you need to be able to develop. So you need multi-year commitments with significant HR capabilities, all sorts of incentives, and that's a difficult thing to outsource. So I am a little bit skeptical. I think there are some areas where private equity could add some value. I mean, I think perhaps a lot of the large private equity firms, such as the Carlyle Group, have a global portfolio of companies, and what a great way to optimize a global portfolio of companies by bringing them into this region. And perhaps partnering with some of the groups in this region that are executing really well. I mean, that are doing things really well. I mean, for instance, our group last year, one of the largest transactions in the region, which was the Azzam deal up in Turkey, we were the acquirers of that. So it went from one family group to another family group. And we have 30 different business groups, and we have a number 1 and number 2 market share in each of them. There's a reason for that. There's a reason that in all developing economies, you typically find most of the leading companies there tend to be multi-business companies. These are economies with some difficulties, and some difficulties within the overall structure. And being part of a larger group brings a lot of value and many advantages.
Good, thank you very much. We're cruising along quite nicely until that about the positive side of private equity. I was a little bit of a bump in the road. A little bit of a bump in the road. I was wondering, in terms of going back to our first question, which I thought we're getting to an answer to, was and what David posed was, is private equity a good thing for the Middle East? David, maybe you'd like to respond to some of that.
Well, if I was part of a large family company that was doing so well in the Middle East, I probably wouldn't want a lot of private equity firms coming in either. You've got a good thing going here, and you deserve a lot of credit for doing that. I think the issue really is not to me whether private equity is going to come to the Middle East, because I think it will. I think it's like trying to put your fingers in the holes of a dike and saying don't come, and inevitably somehow private equity will come, either through global firms or through local indigenous firms or through other means. I think the question really is, how can private equity best help the Middle East improve its companies, and how can private equity be an effective player in the Middle East, and how can private equity do something better than it's done in the West? One of the things that we haven't really addressed is this: what is it that private equity people actually do that makes these returns come about? And I should say that the returns that you did allude to in the 70s and 80s were very attractive, and you're correct. Many people were not sophisticated sellers, and they didn't know what they were selling to buyers in the 70s and 80s, and the buyers did quite well. But over the last 1 year, 2 years, 3 years, 5 years, the returns in private equity, the top quartile firms in Europe, United States and Europe, are better than they've ever been. And that's why I think people are continuously giving money to private equity firms, because they're showing even now that they're able to add value. But what is it that they do? People here who are not in the private equity world probably wonder, what is it that private equity people do that's so wonderful that makes companies work better generally than they did before? It's not a lot of secrets. What it turns out is that, one, if you use leverage, for sure, leverage improves the returns on the equity. So that's one factor. But secondly, what private equity people have done is they've incented managers in ways they haven't been incented before. It's amazing how if you take a manager of a publicly traded company and he's doing okay, but you tell him he's now going to run the company as a private equity operation, and he will own a large part of the company, all of a sudden that CEO finds ways to make cost cuts, finds ways to do things he didn't do before, because he has a much greater incentive. The private equity people have been wonderful at giving incentives to managers, and not just the top people, but throughout the management operation. Third, the private equity people spend an enormous amount of time learning the companies before they tend to make investments, and they tend to go in with 100-day plans or 200-day plans to try to make changes relatively quickly, and a lot of these changes are probably ones that should have been made before. But also, private equity firms like ours can open doors, as you suggest, to other companies that we might own, or can provide networks and networking contacts that can be very useful for selling new products or to bringing in new suppliers and doing things much more efficiently. Private equity people are not magicians, but they do have some abilities to make things work a little bit better. I don't really think that the large family organizations of the type you're with will disappear, nor should they. But I do think that private equity will come to the Middle East and play a role, and I think it will have to play a much more careful role than it played in the West, where it won't have to, it shouldn't focus only on rates of return, but should focus on being a more collaborative partner with family organizations or with governments. But I think it's unrealistic to think that private equity will not be coming en masse. The final point that you mentioned is a very good one, which is that there's already a lot of capital here, so why do we need more capital? Yes, of course there's a lot of capital in the West, there's a lot of capital in Asia, and private equity is operating effectively there. The real issue is, how is the capital deployed? And I think when private equity capital is deployed efficiently, it can add value in areas, even if there's already a lot of capital in the region already. And what private equity is bringing to the table mostly is not just capital, because capital is, as you suggest, a commodity today. It's readily available. It's, I think, expertise, contacts, experience that is really the valuable thing that private equity is bringing to the table today.
Thanks, David. Just to elaborate a little on that, could you just tell us what, you gave a very good description of the generic benefits of private equity, perhaps something a little more specific about the region. What are the sorts of other dimensions that are peculiar to the region that you take into account in private equity here?
Well, first, when you talk about the United States basically is one country, 50 states, and the culture, while it may differ from the South to the Northeast to the West, relatively it's the same culture and the same economy. And to some extent, Europe, while it has many different languages and cultures, is to some extent becoming more and more of a unified European culture. The Middle East, when you talk about the MENA region, you really are talking about different parts, and they are completely different in some respects. What is going on in Morocco or Tunisia is not necessarily what is going on in the Gulf. What's going on in Turkey is not necessarily what's going on in the Levant area. So you really have to have different, I think, perspectives and different techniques to use in the various parts of the Middle East. You can't just treat it all as one area. But if you did treat it as one area, just think about this. The population of the MENA region would have added together be the third largest country in the world. And if you were to take the GDP of the MENA region, just add it together, that would be the fifth largest GDP in the world, behind only United States, Japan, China, and Germany. MENA would be fifth. So while it's a very different region and there's different cultures and different business techniques, when you think about how massive the GDP is of the region now and how large the population is and the growing population, it turns out it's a very attractive area in which to invest. Relatively speaking, as you suggested in your remarks, private equity capital as a percentage of GDP is relatively modest in this region. And therefore, for people who like to go to places where there's less competition, the Middle East offers a very attractive place because there's, relatively speaking, less competition here than the United States or in Europe. In the United States today, there are roughly 2,500 buyout firms. Maybe I would suggest 2,499 more than there should be, because there should only be one. But clearly, I'm not sure the United States needs 2,500 buyout firms. And Europe probably has about 800 or so buyout firms, and maybe Asia maybe has 300 to 400 buyout firms. But the Middle East, relatively speaking, the whole MENA region has a relatively modest number of private equity firms or buyout firms, and I think there could still be growth here without there being too much competition. Generally, private equity people are pretty transparent. They're looking for places where they can deploy capital, improve companies, in 3 to 5 years sell, get a good rate of return, and go about their business and looking for other companies. Nothing nefarious about that, in my view, provided that they increasingly recognize that when they operate in the Middle East, they need to be sensitive to local cultures. They need to be sensitive to what they're doing with workers. They need to be sensitive to things that they didn't probably pay as much attention to in the West. And it's my hope that Middle East private equity capital, while not following necessarily what's happened in the West, can actually be a leader. In other words, very often people might come to the Middle East and say, well, let's do private equity as we did it in Europe or United States or Asia. It's my hope that the Middle East can evolve a blend of private equity that has the best features of the Middle East culture and business environment and some of the best features of private equity culture, and show the West how private equity can be done in a much more conducive and efficient manner than has really been done in the West.
Thanks. Omar, you want to say something?
If you don't mind. Mr. Rubenstein, I just had an exception on a couple of things that you raised, that there's not much private equity capital here in the region.
Relative to the GDP compared to the United States, if you take the GDP of the United States, compare the amount of private equity capital, and then compare the GDP of the Middle East, and compare that to the amount of private equity capital as has been raised, it's still about a third in terms of the GDP.
Well, actually, the numbers that I have is the U.S. It's at 1.6% right now, and the Middle East, 2006, is at 1.1%, and with projected capital to be raised in 2007, it'll bring, and with an embedded growth rate in the GDP, that puts us at 2.4% of GDP. The U.S. is at 1.6%. So we're at the beginning stages, and we're already, I mean, there looks like there's a huge overhang coming up right here. I mean, and so when everybody says, you know, the private equity is in nascent stages in the region, I mean, so you have more capital raised as a percentage of GDP than either Europe or the U.S.
Yes, but, you know,
the
the
two
numbers...
most developed economies out there.
Well, you have to be careful in using statistics in this case. The amount of capital deployed in the United States last year in private equity deals would be probably in equity, probably about $100 billion, or over $100 billion of equity last year, not counting the debt. In the Middle East, that number might be about $2 billion. So it's still a relatively small amount of money by any comparison.
Exactly. The amount deployed is really small. But that capital has been raised and been there for quite a while. I mean, there's a reason these things aren't getting traction. There's a reason that 70% of the capital that's actually been raised for this region is being taken out and being invested in round F of some deal in Silicon Valley because it's somebody's table scraps and nobody else could get it. I mean, For investors for this region, if you want to get India exposure, if you want to get U.S. exposure, go invest in a U.S. private equity fund. Go invest in an India private equity fund. Don't let some guy who in year 3 says, oh boy, don't have much to invest in. Let me see what else I can get.
But that would just go to the fact that we are still in an infancy in this industry, in this region, I would think. I don't think that's an argument.
If people are investing in Middle East...
Or maybe the opportunity isn't really there.
If people are investing in Middle East private equity funds and those funds are not investing the money in the Middle East and they're putting it in Silicon Valley, those investors should look at the charter under which the private equity fund was raised, and that's, it's perhaps not consistent with that charter or the mandate. So I'm surprised if a Middle East private equity fund is putting money in Silicon Valley and that's what was supposed to be done. I don't know why they would be doing that.
I think
we might move on. Henry, you wanted to say something about this?
I think when we're looking at percentages to GDP, it's much better to look at non-oil GDP because the oil sector of GDP doesn't contribute much to domestic activities. By the end of this year is going to be around 40 billion raised over a GDP in the region of 600 billion, so 40 over 600, which is sizable, much higher than in the USA, but as Mr. Rubinstein correctly said, it is not being deployed, a small fraction of it is being deployed. Another specificity for the region, we're looking at Sharia-compliant private equity firms. The challenge here is we have ample Islamic funds in the region. How to draw on these funds to finance Sharia-compliant private equity? The trick is in the financing. The trick is in the 90% debt rather than equity. There is no debt allowed. So how can we utilize the resources available Islamically to meet the requirements of the Sharia-compliant private equity fund?
And what's the answer?
Increasingly, we're seeing new ways of participation. It is not borrowing as such in as much as equity participation from the available funds in the region. So less debt and more equity, which distribute the risk more evenly among participants.
We've seen the development of aspects of private equity issues come up here and the development for a need for a local model. Saad, do you have a view about whether there's a local private equity model that's going to develop here that has particular characteristics?
Sure. I mean, I think in terms of private equity, I think one has to be opportunistic in the Middle East. I mean, you cannot focus. I know that some firms focus only on buyouts, but I think in the Middle East to be successful, a private equity firm should have an opportunistic approach, doing buyouts and minority investments as well. I mean, you cannot make money by being too specialized here. I mean, you can specialize by sector. I think that's a different story. But in terms of nature of the investment you do, whether it's buyouts or minority, I think you should have an open mind. I think a big challenge to the private equity industry, again, is the legal framework. I mean, a lot of time, I mean, I'm speaking about myself. I mean, we sign a shareholders agreement. We never know if that shareholders agreement is enforceable in court. I mean, that's a big thing. I mean, there's no case precedents in courts here about various agreements, and that's something that has not been tested yet, and that actually can have a serious impact on the growth of the industry going forward. But I think, as Mr. Azzam said, with the DIFC, with Qatar, etc., hopefully that will be taken care of. But if you're a Cayman Island entity trying to buy a company, I mean, you need to be creative in making that work.
Okay. Sharif, do you have something to comment? We'll go to the audience after this. So.
Well, I think, I definitely think that the Middle Eastern model of private equity is a lot different to the model in the West. First of all, I think you need to have very strong portfolio management techniques here. You need to have a very strong post-acquisition operational capability, because many of the businesses really requires serious management input, and therefore it can't just be outsourced. And therefore I don't agree with Mr. Ghanim about the role of consultants in that process, because I mean, with due respect, consultants to a great extent would, borrow your watch to tell you the time, and very often they wouldn't be putting their money where their mouth is. And if you took McKinsey for 7 years to do a thing, I think the cost would be tremendous. But you therefore want entities like the private equity firms which partners with their clients. And that's the essential thing, because the private equity firms are putting their money where their mouth is. They're creating an alignment of the principal agent conflict that typically exists here in family businesses. The owners are so removed from the managers, and who best to align the ownership and the management than private equity firms. I think, we as a firm, for example, we operate with a lot more people than typically in the West, but I think that's essentially got to do with the fact that today the service providers in the Middle East are limited. Confidentiality is not very often preserved in the Middle East. The portfolio management techniques that you need to deploy here are very different to the West. And the industry, whilst being at a nascent stage, the opportunities over the next 5 to 7 years are in active management of businesses and taking control of businesses, better financial discipline of businesses, more budgetary constraints and rigorous financial procedures, as also the use of leverage, which Mr. Rubenstein referred to. I mean, most businesses here, like Shakespeare said, never a borrower nor a lender be, believe in that, and are under-leveraged and under-managed. Yeah, absolutely.
Well, let me just add one point that we didn't address, and that is, leaving aside whether private equity should be handled a certain way in the Middle East or is needed as much in the Middle East as maybe it was in the West, what is private equity really trying to do other than get rates of return, and what has it accomplished? In the United States, it was thought in the early 1980s that Japan was going to overtake the United States as the most efficient and productive economy in the world. And that didn't happen. And why didn't that happen? Well, because in the 1980s, the United States completely retooled its economy, made itself much more productive, in large part because people began to focus on shareholder value in making companies more efficient and getting rid of some of the things that had been done throughout the 50s and 60s, but just weren't that efficient. And as the U.S. economy became more efficient and more focused on returns and more focused on shareholder value, that concept was being watched in Europe and in Asia, and the European economies began to transform themselves and made themselves more efficient. And now the United States and Europe and Asia are, in a sense, in a bit of an economic battle to see who is going to be a survivor and a leader in the 21st century. I think if the Middle East is going to play the role consistent with its wealth in the 21st century, it needs to employ some of the techniques, not all, but some of the techniques that have been used successfully in private equity in the West, and to try to make its own companies, to some extent, much more efficient and its own economies much more efficient. And if it does so, given its wealth, it's clear that the Middle East will be an effective force in the global economy in the 21st century. If it fails to do so, I'm afraid that the Middle East will not play the leading role that it really deserves to play in the 21st century economy.
Comment?
I totally agree with you. We have to step it up a notch. We're entering into a global work economy. WTO is coming in. Let me present an argument. If you take a look at Primeria, they have $26 billion in turnover. Take a look at KKR. They have $22 billion in turnover. Multi-business companies running, wide range of different industries, being fairly successful in running each and every one of those. And that's sort of the future state of how private equity companies have developed in the West. And one could present the argument that a very well-run multi-business group here in the region would look fairly similar to a Primeria, would look fairly similar to a KKR. And maybe that is a model that works. Maybe the traditional, just applying the same thing that worked in the U.S. And yes, private equity had a huge part in turning around the economy of the U.S. So, taking out cronyism of publicly traded companies. And I think actually that's something that private equity could do here. I think going on some of the public markets and delisting them and fixing some of the gross governance problems that are there, I think is a role that private equity could play. Overall, I don't necessarily think that private equity is going to come in and be the silver bullet that's going to address all of our needs across and make us more competitive.
I agree that there's no one thing anywhere in the world that's going to solve all the problems, and private equity isn't going to solve an economy's problems. I do think that private equity can play a role that can be useful in the Middle East if it's used appropriately and recognize that it's not a savior. But clearly, if you have a well-run family organization, and I'm sure you know of one at least, private equity probably doesn't play a lot of value in that, but there aren't that many organizations like yours that have, things working so well. Many private equity firms could probably add some value to some private family organizations if they want to. And they can do it in private. And that's one of the things that the word private equity, people should understand what that word really means, because some people who are not in the industry may not understand. The word private equity is a bit of a misnomer in a sense. It's a clever phrase, but originally these were called, as I mentioned, bootstrap transactions. You were buying something with somebody else's bootstrap. You're pulling yourselves up and using borrowed money to get something done. But the word bootstrap seemed a little bit inarticulate, or not quite really describing what was going on, and people didn't like it. So they went to something called leveraged buyouts. But then the word leverage became odious because some deals didn't work out. So they went to something called management buyouts, because management was thought to be better than the word leverage. But in the end, somebody came up with a clever phrase called private equity. I'm not sure who did, but he deserves an award for it, or she deserves an award for it. It's a very clever phrase, but it's a misnomer in the sense, or misleading in the sense, that what is private about it is that the money that is being invested is being operated in the private context. In other words, what you do in private equity is you tend to operate something in private, not in public. And when you're in private, you don't have to worry about some of the things you have to do in public. One of the problems with being a publicly traded company now in the United States is not just you have to give quarterly reports to shareholders and you have to comply with Sarbanes-Oxley, but you have weekly, hourly obsessions with stock prices or earnings on behalf of hedge funds and other activist investors, and a lot of CEOs don't want to put up with that. So private equity operating in the private context can do a lot of things for companies that private equity probably couldn't do, applying the same techniques in a public setting, because even private equity can't do certain things in a public setting because of some of the constraints that exist in our laws.
And your definition of private equity really, I think, is that's a model that creates value, but that doesn't really apply to us. I mean, there aren't companies out there where you have
to agreement, I think. Questions from the audience? Yeah. Have a microphone. And could we bring the microphone down? Here's the other one down here.
Claude Begley, Deutsche Post, DHL. It seems to me that in terms of funding, multinationals, private equity, or families can have relatively easy access to the money. I'd like to understand what is your view about management, because I think they are attracting different type of managers. And now that private equity moved from something which was niche at the beginning to mainstream, there will be a competition for managers in multinationals versus private equity. And in my view, the most interesting point in private equity is that it's capable of attracting entrepreneurs. Those people who made a career in multinationals with the red tape, with complex political internal situation, with matrix organizations. Not only they can get more money into private equity, but they have more fun because it becomes much more result-oriented. So I'd like to have the views how family businesses or private equity firms could attract managers and bring entrepreneurship at the forefront.
I respond first by saying that it's a very good point in that today, when many people went to business school, their goal was years ago to run a large publicly traded company, and the great goal would be to run GM or General Electric or IBM. Very few people who go to the best business schools today are desirous of running GM or General Electric or IBM, because the truth is running these large companies is really difficult, given all the pressures against you, and the compensation is not as great as it should be in a more entrepreneurial private equity setting. So people really don't want to spend 25 years working their way up a totem pole to maybe or maybe not get the top job. What people prefer to do is to have some benefit for their work much more closely associated with what they have done in terms of creating value. And so we find, for example, that we can recruit almost anybody to be a CEO of one of our companies today. One of our companies, for example, which we bought with others, is in fact now called Nielsen. It does the television ratings that many people are familiar with. We recruited the vice chairman of General Electric to leave one of the biggest companies in the world, and he had a chance to be the CEO of General Electric. He left to run a relatively modest company compared to General Electric. Now, why would he have done that? Because he had an economic incentive that would have made him much wealthier by doing this, and also the fun of running something in private and the challenge of building something was much more creative to him. Today, as we suggested earlier, money is, relatively speaking, a commodity. You can borrow all the money you want and you can raise all the equity money you want. The hardest thing to do in our business is finding a deal that isn't completely auctioned off and is relatively available on a proprietary basis. And the second most valuable thing is finding a CEO who's very good at running these kinds of companies. And we spend an enormous amount of time looking for potential CEOs. And what we find is that if you find somebody who's very good in running one of these companies, he or she will probably be very good at doing it a second or third time. If you find a CEO who's running one of your companies and within 6 months you realize he or she is not that good at it, it doesn't get better. In other words, if you're married to somebody and after 6 months you realize maybe you made a mistake, it doesn't usually get better in the next year or 2 or 3. Well, the same thing may be true with CEOs of leveraged buyouts. If you're not very good at this, in 6 months it will be apparent. But if you're very good at this, you're worth your weight in gold, and you can do this serially. And what is attractive to these people is the opportunity to do something in a private setting, to make a great deal of wealth compared to what they can make elsewhere, to be their own boss, and to have partners or investors who really understand and talk the same language as they do.
Martine Mitchell of Korn Ferry International. A question for the private equity players on the panel is, in the context of the Middle East, or specifically in the context of the region, how far are you actually building up your post-acquisition teams with industry professionals who can add value to the businesses over and above just this financial engineering that we've been talking about? So that's a question specifically for the private equity players.
I'm sure Korn Ferry could be helpful in finding some of those people, I no doubt, right?
I think increasingly most private equity firms, at least the good ones, are adding post-acquisition, developing post-acquisition teams, and those people tend to have two kinds of backgrounds. Some of them come from the consulting firms, and some of them, if the private equity firm has a industry focus, I mean, you would like to hire some industry veterans, like some former CEOs of some leading companies in that industry. But I think for a small firm that doesn't have an industry focus, just hiring some ex-consultant or operating types can be sufficient. You can draw on the expertise of some industry specialists by hiring, for example, for a year a CEO on a consulting basis to bring the industry expertise. Again, it depends on the size of the firm. But that's an important, post-acquisition is becoming a key driver of generating value in the Middle East. I mean, you need to add value to your portfolio companies.
I think to be a responsible private equity manager in the Middle East, post-acquisition and that's really a point that you touched on, which I think is very relevant. I think most firms here are not being responsible managers in many respects, because I think most firms here are trying to take the Western model, and the Western model is very reliant on outsourcing, on doing pipe transactions. It's very different here in the Middle East. And I think to be a responsible private equity manager in the Middle East, your post-acquisition capability and your post-operational capability has to be very strong. And that means investing in a lot of people. It means investing in expenses which come out of your management fees. But that's what a responsible manager in the Middle East needs to do.
To give a serious answer to your question, for those who are not that familiar with the private equity industry, there are two basic models of how when you buy a company, what you do once you own it. One is what I call the Stockholm Syndrome method, which is the person that did the deal and has bonded with the CEO, stays with that CEO, and is the person who oversees the process. It's called the Stockholm Syndrome because in effect you become a prisoner with the CEO. You're in love with the CEO, and you may not be able to really say to that CEO, you're not doing a good job anymore because you've bonded. You seduced that CEO into doing a deal with you, and now you're not going to be the tough person to say you're not really doing it adequately. The other method is to say that the person who did the deal, thank you very much for doing the deal, you go do another deal. We have a Mr. X over here who's going to oversee the company, and he may not be so pleasant and so seductive in his skills, but he knows how to operate a company, and he knows what to tell the CEO. Increasingly, the latter model is being used in the West because the companies that are being bought are so large and there's so much money involved that you can't depend on the person who has the deal skills to get a deal done to necessarily be the person who oversees the deal. When KKR did the RJR deal, for example, in 1989, they only had 7 investment professionals, the entire firm. So they didn't have a lot of people to oversee these transactions. And Lou Gerstner, who's now our chairman, was the CEO, really was dealing with the people who were the deal people at KKR. Today, KKR may have 200 investment professionals, many of whom have operating experience. In our firm, we probably have 800 people, and 400 of whom are investment professionals, but a lot of them have operating experience. And increasingly, we take people with operating experience and ask them to oversee the companies because they often really have the better skills in that. And I think you raise a very good point. In the Middle East, probably increasingly that should be done here as well.
Thank you.
Ali Shahabi from Rasmala Investments. I think we have a problem with definitions here because with the statistics that are being mentioned, 2 things. We have to define the Middle East in a way that everybody agrees on. And people have defined the Middle East by adding Turkey, the Indian subcontinent, and even North Africa, which really, if you relate them to the GCC and Egypt and the Levant, are not very related. Secondly, we have to define private equity in the Middle East. 5 years ago, nobody knew what private equity was. If you define, in the Middle East, if you define private equity players and private equity in the Middle East as professionals who go and get third-party money, deploy it in companies, and create value, the number of players today can be counted on your hand. Many of them are represented on the panel today. So I think if you come up with a careful definition of private equity and a careful definition of the Middle East, you'll find that this is really a very young industry, very few players who have serious experience, and they have been operating in a difficult environment. The Middle Eastern environment has a lot of lazy capital, which is government and family capital that's not necessarily driven by return on equity. So the industry the statistics that we talk about do not explain the reality on the ground. At the end of the day, this region is benefiting from some of the indigenous players that have the experience. It will benefit from the big players that come in, and the big players should try and work with the regional players that understand the space. But it is a young industry, and it has very far to go, and it will add a lot to the industry.
Good, thank you. You need to turn it on, I think.
Mazi, I'm the Managing Director of Technology Investments Company, a very focused private equity company, if you like. I just want to add to what Ari has said. He has done what I wanted, half of what I wanted to say. Yes, first of all, the money raised are usually raised from certain countries, but there are other countries in the region that need that capital. Second, I would like to say, I mean, if you take the whole region, you're talking about GCC? Are you talking Middle East, including Africa, North Africa? Are you including Pakistan? Are you including Turkey, Iran? If you do that, then I don't think there is a problem of spreading the money, not as much as the situation has been described here. Number 2, I think many of the private equity companies come loaded with people with financial engineering background, not from the industry itself, and they are not very well defined private equity. They are everything for everybody. I think if you define that, you will not have a problem with getting your deals that you need. 3, and this is something, you know, our experience is very short and very focused, and it is in the region, in the definition I have just said, with primarily saying Middle East, means first of all, my own country, Saudi Arabia, then GCC, then the Arab world, then maybe 2 other or 3 other countries. If we do that, the experience I have seen is the following. You actually add value to these companies, especially if you don't try to take over buyout completely.
Just a few more seconds.
Okay, just if it's not complete buyout, and if it is minority investment, then you get better reception, and you add a lot of value. The value is added through, but just being there, just making the networking, just getting the experiences that you have shared, you have learned somewhere else, shared, and also by adding some of the governance that some of these countries do not have yet. Thank you very much.
Thank you. We're just about out of time, so I just ask the panel if there's anything that they would like to add to the discussion.
Just want to ask people, how many people here are now, as a result of this, ready to invest in Middle East private equity? Please raise your hands. Anybody? How many are now convinced they shouldn't? Okay, thank you.
A lot of people sitting on the fence. Well, I think we've had the benefit of a great panel, a great lot of experience in private equity, and I think it's been quite elucidating in terms of some of the characteristics of this industry in this region. Private equity is a train that's well and truly on its way globally, and it seems to me that it's well and truly on its way here. But private equity is a generic term that covers a lot of ills and a lot of things. So I think that one needs to think about private equity here in a fairly new environment for private equity in an industry that's fairly new. And I think the challenge for this region is to actually work on getting the right partners with private equity here that is also sensitive to the cultural and language elements in the region. So I'd like you to thank the panel for their contribution, and I thank you for participating. Thank you.
isn't used effectively enough, or goes down a black hole, and it ends up being I think there was a good deal of effort on the part of the Palestinian Authority to build institutions and to improve governance. And actually, we have gone through cycles where donors were hesitant first and they did not send money to the Treasury Palestinian Authority. Then there was a period of time, actually it was 2002 to 2005, the donors actually started to transfer from the Palestinian Authority directly. Last year was not the case. We have really experience with both ways of doing things. But once again, donors, I think, have to see an end to this, some graduation in the Palestinian context, quite frankly. It's difficult to see how that can happen when there is no possibility for economic